Welcome, everyone. Quick webinar update on the Secure Act 2.0 and changes that have taken place, and then a brief market update with what's going on within the economy and the stock market. I'm one of your hosts today, Chad Seegers. I'm a managing partner here at Insight in the Houston office, and speaking as well is going to be our partner in California, Brian Stormont. Today, we'll cover Secure Act, what's gone on with the changes in legislation now that it's official, a brief market update, and then a brief update on some technology changes we've made for our clients at the firm here. So we'll go ahead and start with the Secure Act 2.0. And Brian, I'll send it to you.
Yeah, thanks a bunch. So again, Brian Stormont, one of the managing partners here at Insight Wealth Strategies here in Northern California, where it is cold and rainy. So it obviously must be mid-January. No, it's actually May 3rd, when the winter does not ever want to seem to end here. But I digress. Today, we want to talk a little bit about Secure 2.0 and talk a little bit about what we're seeing in terms of the impact of those new regulations and real world experience. So how is this actually impacting clients? So when we talk about Secure 2.0, this is a regulatory change that came through at the very end of last year, and it made some significant changes to particularly retirement accounts, but also 529 accounts. In fact, there was nearly 100 changes in the rules that probably impact you whether you're working or retired. There's almost, basically, if you interact with any of those types of accounts, there's some rule change here that probably had some bearing on how you're going to approach those accounts in the future. Overall, the changes we find to be mostly investor friendly, but they can be quite complicated. Of course, Congress is never good at doing things simply, and this is a good example of that continuing to be the case. Now, some of the rules that we're going to be talking about take place this year and go into effect now. Some will get layered in over the next couple of years and really over the next 10 years in a couple of cases. So what are some of the big changes that we're seeing right now that are having immediate impact? Well, the first one is really the required minimum withdrawals. So for folks that are further along into retirement, you know that at some point along the way, the IRS is going to force you to take withdrawals from your taxable retirement accounts, whether you like it or not. Historically, that age in which you had to do it was the year in which you turned 70 and a half. With Secure 1.0, that got pushed back to age 72. Last year at the end of the year, it actually now got pushed back to age 73, and that became effective this year. So we came into the year with a number of clients thinking, oh, this is going to be a year you're going to be forced to start taking withdrawals, and now all of a sudden they don't. And in fact, in 2033, so this is a good example of a long-term layered-in change, the required minimum withdrawals will push back to age 75. So again, some planning opportunities we'll talk about here and how that impacts people. One other notable change with regards to the minimum withdrawals is that the penalties for missing a required minimum withdrawal are going down. Now, historically, the IRS often waives the penalty, and we've helped clients fix those mistakes in the past. But the fact that the penalties are going down is really, I think, a nice change with regards to the IRS regulations there. Now, with regards to 529 accounts, so here, really important change. If you have old legacy 529 accounts, you've got kids that are out of college and those undergraduate or higher education expenses, they're gone. You don't have any more need for the 529 account. You're wondering what to do with that account. Under the right circumstances, up to $35,000 of those dollars can be moved over to a Roth IRA. Now, the rules there are quite nuanced, so this is not to be taken lightly or done just off the cuff. This is something we would definitely want to have a chat with you about to understand your situation. But the really important point here is that money is not tied into a 529 account where you'd have to pay penalties and taxes on any unauthorized withdrawals. So really, really nice change in the rules in that regard as well. And then lastly, another big change that we're seeing that's going to really impact people starting next year, and that's with regards to retirement plan changes. Now, again, lots and lots of little nuanced changes in various retirement plan regulations, but this is one that we think is quite important to take note of. So starting in 2024, if you earn over $145,000 and you're over 50, so you're trying to make your catch-up contribution, stuff as much money into that retirement plan as you can, that catch-up contribution is going to have to go in after tax as a Roth contribution. Now, that's not necessarily a bad thing. Those Roth contributions will mean that there'll be tax-free withdrawals for you later on down the road, and that can be quite favorable. So it's not a terrible change in the rules, but it absolutely means that for people that were doing pre-tax catch-up contributions this year, your taxation next year will in all likelihood go up because you'll be losing some of that tax deduction. So it does present a little bit of thinking this year as well. I'll talk about that in a moment. Also, with regards to company matches, retirement plans can now make those matches as Roth. So previously, those company matches were only taxable contributions, meaning that once you took the withdrawal later on, you'd have to pay income tax on it. Those contributions from the company now can go in as Roth, and that we think is terrific. So again, some of these rules really are very consumer and investor friendly, and we really like what some of these things mean for the future. Now, what are some of the planning opportunities here? So first and foremost, with that, the age extension there on the required minimum distribution, for folks that are doing Roth conversions, that could mean a considerable more years of being able to do it. So one of the things that we know with clients is that oftentimes you can go into this valley after you stop working, but before your required minimum distributions, and those low income years could represent an opportunity to do Roth conversions. So what you're seeing on the screen here is an example of that. Our software, this is exactly the type of planning we like to do, where we like to identify, hey, are there any dips in your taxable income that could present a planning opportunity? This is an example of an actual client where their taxation is going down quite considerably for a number of years. They're going to pull from other resources, and we're going to do some strategic Roth conversions to be able to, at a low tax cost, move that taxable money over to the tax-free bucket. And of course, now we have a little bit more time with that new rule. So that's a really, really nice turn of events. With the change in the catch-up contribution. So as I alluded to just a moment ago, all else being equal, it is unquestionable for those catch-up contributions, your taxable income in terms of taxes will go up next year. So it does make sense to kind of think about your just overall situation for 2023 and think, hey, are there any taxable strategies that I want to implement right now before my tax situation changes next year? And again, these are the kind of conversations that we really would love to have. And then lastly, for those excess 529 accounts, go back and take a look at those. If you have one of those things languishing out there somewhere, let's go identify it. Let's take a look at it. And again, the rules are a little nuanced there, but if under the right circumstances, we can get that money over into a Roth IRA. And now it's tax-free money for whatever you want to spend it on, not just higher education. So again, some really interesting rule changes that have occurred. We're excited to take a look at it and see how it might impact each one of our clients. And today we just wanted to highlight a couple of the top level things that we see impacting people today. So I look forward to having that conversation. Now, Chad, I'll turn it back over to you. Let's talk a little bit about what's been going on in the markets. It's been an interesting year, to say the least.
Thanks, Brian. Yeah, and the environment just keeps getting more interesting. As we're recording this, we have an upcoming Federal Reserve decision in about 45 minutes, where highest probability is for the Federal Reserve to hike interest rates one more time. And it's looking like they may pause after that. We obviously have stuff going on in the banking sector as well. So let's take a look at what matters with respect to the economy, what to look out for, listen for, and then we'll see how that applies to the overall broader stock market. So GDP, as everyone knows, this is kind of the recession, quote unquote, that everyone sees coming. And overall GDP, going back to 2021, you see it's declining in how fast we are growing coming out of COVID. Obviously, we grew quite a bit after shutting down the economy, but it seems to be hanging in there. The economy just simply won't come to a screeching halt just yet, which is why the Federal Reserve is continuing to try to raise interest rates to slow down inflation and some areas of bubble type growth. When you take a look at the indicators that determine whether or not we are in a recession, as you see the past 20 years of data, you have a few things that turned negative. Retail sales last year, when you factor in inflation, wholesale prices earlier this year, but otherwise we're sort of not in the environment that you saw near the financial crisis, near the tech bubble, and obviously with the pretty dramatic and fast downturn with COVID. So what is the recession? You've got a slowdown of economic growth in a few key areas. How long do they last? Typically, they last about 10 months, plus or minus. The financial crisis was a bit of an outlier, along with the 70s and early 80s lasting, around a year and a half. And so 10 months is about as long as these economic slowdowns occur. What happens with them is obviously an increase in the unemployment rate, a slowdown in the growth of businesses, and then things tend to return back to normal. As far as the stock market goes, you've seen an average drawdown post 1950 of about 30% of the stock market during the recession. What you then notice here on the far right is your 1 year, 3 year, 5 year return coming out of a recession is a pretty big outlier. Recessions, create a good bit of opportunity when it comes to the markets, when it comes to your retirement accounts, especially if you've been a little bit more conservative on one hand, or if you're continuing to contribute to the 401k, you're going to be buying some of these assets that are at depressed prices, and you're going to catch some of that good growth coming out. You see a lot of situations where post World War II, the stock market has actually been positive during the recession. And so it's not a foregone conclusion the stock market has to completely sell off the day a recession starts and it stays underwater the entire time. Half the time, the market is actually recovered during the recession, and it went on to be positive. It doesn't mean you won't have a typical stock market sell-off by any stretch in any given year. You can have a 14% or so decline, and that's not uncommon. But when you take a look at post-recession, 1, 3, 5 years out, market tends to do pretty well. What you want to keep in mind, especially if you're nearing retirement or in retirement, is you want to have your expense needs protected, in a bond market type, money market type bucket, to where you're not exposing yourself to a 1 and 3 year drawdown in the stock market. You don't want to be providing yourself income from that side of your portfolio near term. So for the economy itself, we are seeing some early signs that things are entering a recession territory. One is continuing jobless claims. This is a little bit different from what you hear about job openings out there, and unemployment rate is very low right now in the United States, which is great. Seems to be plenty of jobs, but currently continuing claims, people that already are laid off, they haven't found a position quite yet, has now picked up to a level that has correlated to recessions for the past 50 or so years. So it's a leading concern that we see. In fact, the past year, it's highly lockstep with what you see with the average recession, a year before the average recession here in dark blue versus light blue. So you're seeing some old school characteristics of the start of a recession now. So-called leading economic indicators have dropped to a level that would say, you're going to be whistling into a recession here pretty soon. We've obviously had a couple of bank failures, possibly not over yet with respect to some commercial property issues that we have going on. One thing to look out for with respect to the economy, everyone knows it's been very challenging to find a contractor. It's very challenging to find any type of quick work done on the construction front. And so one thing you typically see, this is courtesy of 314 Research, Warren Pies does phenomenal work. You tend to see construction payrolls decline leading into recessions. And it's almost like those construction workers begin getting treated like a temp worker, because if the projects aren't there, right, they don't need as many construction workers as they typically do. And construction payrolls tend to peak about 4 to 6 months before a recession hits. And then also before those non-farm payrolls as well start to roll over. Currently, construction payrolls are still rising. However, it's not a secret. You've had some pretty significant changes with respect to commercial real estate prices, with single family residential real estate prices across the country. You have pockets of strength, without question. Real estate is very local, but in aggregate across the country, there's some concerns. Multifamily construction is still going up. It's money that was seeded for projects 6 to 9 months ago. If that starts to soften, you're going to see payrolls start to roll over. From the economy standpoint, I want to talk briefly about the dollar. We've gotten a lot of questions about this recently. Seems to be a lot of scare tactic going on about, is the dollar going to lose its reserve status? Is it in danger? Countries around the world are working to take away the privilege we have, quote unquote. I've seen this in my career a couple times. We saw it back in 2012 where Iran was accepting Chinese yuan in exchange for oil. You saw it on the front page of The Economist back in 2004, the disappearing dollar. As of now, if you take a look at the left, you see the total percentage of transactions that took place based in dollars in the economy in 2022, and then all the way back to 1989. And what you notice is it's about plus or minus the same as it was over 30 years ago. So there isn't really any data to back up this replacement of the dollar. It would take years for that to occur. It's a very liquid asset. In fact, if you look at the strength of the dollar, which a lot of people feel like it's, our dollar is quote unquote been falling for years, it's not actually been the case. The spike coming out of COVID pushed the dollar back up to a level we haven't seen in 20 years. You're depending on the day, at parity with the euro after many years of the euro being sort of $1.50, if you will. And so there's been a lot of changes there actually that have been positive for the dollar rather than the concerns that the media outlets love to run with. So what's going on with respect to interest rates? That's a major driver within our economy. Anything financing related, car loan, loan for your house, loan to buy businesses, et cetera. It's all going to funnel from the federal funds rate, and the federal funds rate as of right now set to be a little over 5% by year end. And the voting members of the Fed in dark blue are telling you that's kind of where they want their upper bound to be. And this is as of April. And then over time, the next few years, they're going to moderate interest rates back to sort of a longer term level of around 2.5%. And we go through these cycles where the Federal Reserve raises interest rates with these stair steps, and you see the flat line. This is a so-called Fed pause. Typically, the Fed pauses for 6 or so months before they begin to cut interest rates again. Some cases to begin to stimulate the economy via monetary policy. In many cases, unfortunately, it's because something is broken within the financial system. And we're seeing some of those cracks right now with a few bank failures and these high interest rates. And this slows down lending within our economy. And so now let's take a look at how does this affect the overall market? We've got some near-term uncertainty, as you always have, but you got a couple of catalysts to pay more attention to currently. And so this, again, coming from 314 Research, we've kind of been trading in the S&P 500 at least, plus or minus 10% around the quote unquote fair value or the price you should pay for the stock market. That's based on what earnings are doing and where interest rates are. And so as you see below, we've kind of oscillated around that level. Fair value, as of April, sitting around 3,800, which you need around a 10% decline to kind of get back there, or you need earnings to come back up. And so if you back into the fundamental argument, you have a pretty good case for the October 2022 lows plus or minus being a fairly good bottom in the stock market, because that would put current earnings level at a reasonably cheap price with some considered earnings reduction from where we are today. If you get a recession that hits and companies have to start drastically cutting their earnings, it's not a foregone conclusion by any means, though. In fact, what's gone on in the past week is companies have begun increasing their earnings expectation later on this year. And so right when quote unquote everyone knows we're heading into a recession, we just finished 4 consecutive quarters of decline in earnings, and the second quarter is expected to pick back up. If this holds true, you have a meaningful argument for a bottom in the stock market around 3,800 or so. In fact, you would start to look at where earnings are picking up later this year and into 2024. Now, you need that pickup in earnings to take place. Historically, when you had a quote unquote stock market bottom, if October was the low, the behavior you see in earnings would be in purple, where they already have bottomed out and would have started picking up by now. The current cycle that we're in is in light blue, and we actually need to see earnings turn around and actually begin to pick up. That justifies plus or minus 10% where the market is today. If not, you have some serious concerns, some downturn. So you're getting this pickup in earnings revisions. It is turning around. However, the earnings are still on the negative side. You need earnings to prove the market deserves to be where it is. No one knows that data yet without question. Now, some levers that are going to affect that are the next actions by the Federal Reserve. After they stop raising interest rates, that's referred to as a pause. Historically, when the Federal Reserve pauses raising interest rates, the stock market tends to do okay, with the exception of the outlier of the tech bubble in 2000 for a few months. The bond market, on the other hand, which had a terrible year last year, the bond market has always been up when the Fed pauses, and it's been up quite considerably. You may have heard the term Fed pivot. This is when the Fed turns around from raising interest rates to pausing, and then suddenly has to begin cutting interest rates. It's actually not a great thing for the stock market. You tend to have some pretty significant sell-offs on the stock market side of the house. The bond market, however, has done exceptionally well. That's when you have outsized returns in the bond market that you don't normally see. Now, what's gone on over the past year has been interesting. In the face of the very unfortunate Ukraine invasion and fighting going on, developed international, that's going to be Europe, Japan, Australia, etc., has been the one place around the world where you've had a pretty significant performance in your portfolio after years of not seeing that. The aggregate bond market is still down about 1% or so. Emerging markets as well are down in negative territory. Then United States small companies are the worst high level performing asset class. After having a little bit of outperformance into August of last year, and then briefly earlier this year, they've sold off pretty dramatically. They need access to reasonable cost of debt for those businesses, and frankly, they don't have it right now. What's going on with international? We've seen a lot of portfolios that come in the door that were severely underweight international because it was a poor performer. The U.S. simply outperformed the international markets for years and years and years. We then got to a 2 standard deviation move with respect to how cheap the rest of the developed world was to the U.S. market. And we go through these cycles you see here when the U.S. outperforms this dramatic 14-year stretch that we just came out of going through the financial crisis. Europe had a double-dip recession after the financial crisis, and some serious concerns with Greece and Spain and the like around 2011. And then again in 2015 or so. And so for the past year or so, we have just started a cycle where the international markets have outperformed the U.S. markets. And it's interesting, if you think back to what our economy did when we reopened post-COVID, and you think back to the time series of when Europe reopened, which is a little later. Now you have a lot of the emerging markets that are fully reopened, when they took a little while. That's going to have effect on their local economies. It's going to be beneficial also for U.S. corporations that have revenue in those geographic areas, but it's also going to be great for the developed international investments that you may or may not have in the portfolio today, because everyone's been underweight for 10 years or so. That's something you want to look out for. So I'll stop there. I know that was pretty high level. There's a lot going on. Please reach out with any questions you have with respect to portfolios or markets. Happy to answer. And we'll talk briefly now about some technology value add that we have for clients behind the scenes.
Yeah, thanks, Chad. And I mean, just amazing stuff. Our objective oftentimes when we're doing reviews with clients is to try to boil a lot of that data down into, a little bit more snippets. But we really want to make sure that, for folks that are just really wondering, what do we see going on in the markets and the financial system, on a global basis, that we give them that opportunity to really kind of dive a little more deeply. Now we're going to shift gears and talk a little about some changes just going on inside the company right now, a couple of updates that are going on. So, 10 plus years ago when Chad and I joined the firm, Chad, you'll recall, we actually used paper copies to do our data with clients. People actually wrote it down on paper and handed it over. So roughly 7-8 years ago, we thought we were pretty slick when we had this new Excel-based spreadsheet that we were using for clients to either start a financial plan or update their financial plan. Well, that technology now feels a little stale. And so we now have a new system that we're launching here. Now, obviously, the data booklet is a tool that we're using oftentimes for new clients as we're getting ready to build out a financial plan for them. But we want to show this to existing clients because it's not uncommon where we do go back and revisit their expenses or re-update their numbers. And the reason why we want to bring this new platform or system to you is to help you understand that if you want to update your numbers, the system's just a lot easier today than it was previously. So it's this new system from Precise FP. It's faster, it's easier, it's secure data. It immediately feeds into the financial planning software. So we're really excited to launch this. And certainly if you think that you might want to update your numbers with your advisor, absolutely let them know, let me know, let Chad know, and we will be more than happy to go ahead and do that. So definitely an exciting announcement that we're pleased to be able to make.
Thanks, Brian. Next thing that we've added, sort of a value add with clients is some interesting execution with respect to estate planning documents. This is typically a subject matter that is a task hurdle over the years. We can make recommendations to get a new will put in place, and it's just not something you ever or I ever want to do. It's not conversations you want to have. But if you've dealt with it with your own family members, unfortunately, if these things aren't taken care of, they become some serious issues, some infighting with family, lost dollars, lost legacy, not fun situations. And so all it takes is simply executing some documents and putting some thought into how you want things to go. Typically, we would send clients to an estate planning attorney, or a lot of clients would execute with some of the online providers out there, which you can do nowadays, which are fine in a lot of cases, but we would find the documents would get sent to us and they wouldn't be done correctly. Well, we've engaged in a partnership now where we can provide all of our clients a will, pour-over will, your ancillary documents, advanced healthcare directives, and then any type of irrevocable trust work that needs to be done, actually free of charge. Through our relationship, and we can actively see the action that you're taking within those documents. We can review those documents before you execute those documents. You can save them digitally if you want to print off the PDF copy and execute with a notary, and you keep it in your file at home. But you can just simply check the box and get this task hurdle removed and have it done correctly with another set of eyes looking at it. And then ultimately, you want to coordinate what your estate documents say with your financial life, your investment accounts, your retirement accounts, your life insurance, any retitling that needs to be done. And so we have some checklists actually built out for this. And so this is something where it's kind of tough to get excited about estate planning, but from a value add standpoint, we're pretty happy to bring this to the table. A lot of clients thus far have really loved it. So if you need some of your estate docs looked at, or if you need them to be updated, feel free to reach out to us. Happy to send you a link and get this process started for you. And again, that's free to all of our clients.
Yeah, Chad, I just absolutely want to echo that. And certainly for our California clients, you are probably well aware that we are huge proponents of having proper estate plan documentation in place. The California probate system is notoriously slow. It right now routinely takes upwards of 1 to 2+ years to get through the probate system. It's also quite expensive. Tens of thousands of dollars that should be going to your beneficiaries are instead going to attorneys to process all this for your estate. So we can avoid that very simply by getting these documents in place. And that's why we're such huge fans of it. So we are really excited to be able to offer this to clients. And obviously for certain really complicated cases, this may not be the right fit, but for the vast majority of people, this is a great solution. And again, very excited to be able to offer it. So ladies and gentlemen, for speaking for Chad and myself, I just want to thank you all so much for listening in today. Certainly there's a lot of ground that we covered there. And certainly if you have any questions about anything that we talked about today, or frankly, anything else that's on your mind, we always, like to keep an open door policy. So feel free to reach out to myself, Chad, any other advisors here at Insight, whether it's in San Ramon, California, or Houston, Texas, or anywhere else around the country. And we will happily get you on the calendar and go ahead and chat about whatever is on your mind. So again, thank you all so much, and we look forward to continued conversations with you down the road.